Hey, welcome to Patterns and Profits. I'm Tom Gentile, resident pattern trader. If you've ever felt trapped by the emotional roller coaster of news, opinions, and meme-driven hype, well, you're not alone. Here, we focus on patterns, not panic, on profits, not predictions, and based on a proven, repeatable approach that cuts through the noise and helps you trade with confidence. If you want my videos, education, and special reports the moment they're hot off the press, well, then sign up for my newsletter. It's absolutely free. Welcome aboard, and let's get started. All right. Welcome, everybody. Welcome again to Patterns and Profits. I am your host, Tom Gentile. It's Monday, July 6th, just after 12 o'clock. You know what we do here. We look for patterns that repeat, profits that add up. Help me out. Let's get this channel to 50,000 subscribers. We are sitting over 49,000 right now. You can help out by subscribing to the channel. Hit the notification bell if you want everything the moment it's uploaded. And one more thing, which I talk about, practically every video now, is that I have to say it, this is not investment advice, all right? I'm not your financial advisor. Past performance is not indicative of future results. So let's go ahead and get started. How was your 4th? How was everybody's 4th of July? I want to hear from you. I'll let you know. Mine was, we went, my family and I went to Clearwater, and we were up in the channels that go out into Tampa Bay. So we had a good time, but, we actually went to a drone celebration. So let me set the stage here for you. We've had such little rain here where I live that the counties that I live in and the ones around me had bans. They actually banned fireworks. And so we had to go outside the county to see fireworks, but they had a drone show. And everybody in the surrounding areas went to this drone show. So I had a late start getting back from a party, running to a drone show. And by the time we got there, the drone show had started. It was absolutely spectacular. But by the time I was even turning around to try to find parking, I saw people leaving, and I rolled my window down. I said, "What's going on?" He said, "It's over." That's what happens with drone shows. Typical drones, what do they have? About 20 minutes of battery life on them. And that's what ended up happening for us, is that anyway, it was over before it started. So hope you had a great 4th of July. And I hope you're coming back from the markets with all your fingers intact. That is a fireworks analogy. Anyway, glad to be back on the program, guys. One sector I've been paying particular attention to has been the chip sector. And that's, technology, manufacturing, everything around semiconductors. Chip stocks have been on a roller coaster ride the past couple of weeks. Up one day, down the next. That's probably the first thing I'm looking at. And if I were to look at a chart on that, this is what the QQQ is looking like. I'm going to get back to that in just a moment. But, when you think about the other things that are going on that we've got to pay attention to this week in one frame or another, the Federal Reserve minutes, okay, that's going to be on Wednesday. And so traders, investors like me, are going to be looking for clues to whether the Fed is leaning toward rate cuts this year, or are they going to be holding steady? That's a whole conversation about inflation. And when you look at the jobs numbers that came out last week, the market's got a bump on that because they're thinking, well, maybe rate cuts are back on the table. So that's this Wednesday. Thursday, we've got jobless claims. If the jobless claims stay low, it would really kind of support the idea that the economy is resilient. But if we get a little bump up in that, then recession concerns could quickly return. And then when you look at big bulky items, and so, go outside of what we see going on this week. Look at big bulky items. All right. And what I'm talking about, houses. All right. Houses are already expensive. So you can, the only way I see a lot of first-time homeowners, home buyers coming in is if their parents are going to help them out with the very least the down payment on getting into a house. Because It's just, just in the last 5 years, we've seen basically a doubling in housing. And you need, what is it? You need $140,000 a year for an income just to get into a median home. So that's a big bulky purchase. And we've seen houses on the market for, longer than before, not just in Florida, but nationwide. The other thing too, I call it the wants, not the needs, and we'll get into that in a moment too. But here in Florida, especially on the Gulf, boats are a big discretionary purchase, and the amount of time a boat is on the markets, and I've been looking at them, I haven't seen them on the market this long. We see, for instance, catamarans. Catamarans are really nice looking, and I've gone to the boat shows. I've seen these catamarans, and they're really nice, but it's almost impossible to find a dock to put these at unless the dock is your own, because they're so wide. The other problem is so many were built after the pandemic that there is a glutton of them coming out of the Virgin Islands because, they're 3 to 5 years old now, and they're now out of commission. So that's also having to flood the market. So we're seeing the average boat staying on the, when it puts a for sale sign on it, over a year before it gets a buyer. And so that is leading into, I think, a sign that people just aren't ready to go out and make big purchases yet, because they want to see what's going on in the Middle East. They want to see what's going on in their own community when it comes to the economy and jobs before they step up and make a big purchase like that. Now, the other thing it's going to help us determine this is earnings season. And earnings season begins to ramp up this week. You got companies like PepsiCo, Delta Airlines, they're really kicking off. And then we'll see the steel companies come in as well. But banks won't be reporting until next week. And that's where things really start to kick in. And finally, while we're talking about it, SpaceX. All right, so SpaceX is being added to the NASDAQ 100 tomorrow. And so what's happening today is that you got a lot of money managers that have got to, if they hold a lot of the NASDAQ 100, then these are passive fund managers. They got to buy up SpaceX shares before to close the bell today. Well, they're actually going to get a pretty decent move on those, because if I look at SpaceX, and let me throw SpaceX up here so everybody can see it. Here's SpaceX, and this is just what's happened since the, on the days from the IPO. We ran up and we hit a high. It was very close to 230. And from there, we dropped down below 150. But we've been, if you look at the closing prices and even opening prices have found a floor, as of now, have found a floor around the $150 area. Now, I also want to mention, before we continue, that a couple weeks ago, we were discussing SpaceX, and I did several videos. I did a live stream on this, and I said, do not, in my opinion, do not buy options. If you want to play the option game with SpaceX, you want to be a seller of options. You want to be a seller of options because something called implied volatility, and I have it on the screen here right now. That's the red line you see here, was off the charts, right? And what has happened to implied volatility? It is dropped as fast, if not faster, than the price itself. Okay, so the price itself has dropped off, but the implied volatility has dropped off too. And so, for instance, if we were a put seller, and we were a put seller, in fact, we were selling puts anywhere from the day that above the 190 mark. And I think the lower end puts that we were looking at were maybe around 170, 175. So when it's trading down here around 160, you got to be thinking, as a logical trader, you got to be thinking, well, Tom, if you were long the market with, even shorting puts, aren't you down on that trade? And the answer is no, because we sold these put options for so high that even though the market came down quite a bit, that are puts, we have some puts that were out of the money puts that we sold for 250. They're at 180 right now. We have some spreads, and that's another way to sell option premium. But at the same time, you don't have to come up with that big margin amount that you would by selling puts. And we have, we have some puts that we put spreads we sold for $1. They're trading around 72 cents right now. So we want those to go lower because, when it comes to selling premium, you sell high and then you buy back low, or you don't buy back at all with the idea that it goes to zero. So I wanted to kind of follow up a little bit with something we did. What was it? Probably a couple weeks ago, almost a month ago now, as we move forward. All right, let's talk year-to-date numbers. And for that, I want to move over to the slide you see here next to me. So as we enter the back half of 2026, this is what the market's looking like right now. S&P's up about 9.3%. We had a peak of 7,600 in the late spring, pulled back. I believe we're going to move out and break out to new all-time highs here between now and Labor Day. I'll talk about that a little bit more. But take a look at the rest of the pack here. The NASDAQ, the QQQ up about 11%. I was up as much as 16% through May. And you got to think about semiconductor and AI. It really helped drive that up, and that has helped pull that back to where we're up about 11% now. And the Dow Jones Industrial Average really has kind of followed the pack, up about 6%. We hit 50,000, was a milestone earlier in the year, pulled back, and we've kind of came very close to that number, give or take, since then. But this is how these three are really kind of coming together. I look at those at the year-to-date numbers. This is what the year-to-date numbers tell me. Now, moving into the calendar for July, all right, because that's what I look at. I look at, again, I'll look at things like the Qs. And here's the Qs, and this is what, from the low to the high. We saw what the Qs did in April. We also seen them moving sideways since about the 1st of June. When we saw those all-time highs on the Qs. We haven't come back and hit those yet, and I believe we will. But we're creating a bit of a triangle there for QQQ. If I take a look at SPY and get a good idea of what it's done here, a lot of the same thing. Here's that April low, all right? If I were to pull this back and show you what's happened since the beginning of the year. Here's the beginning of the year. Here's the pullback. Here's that sprint from April to the beginning of June. And then since then, we've had a bit of a pullback, getting again close to those all-time highs, breaking out. And, if you're a Y guy, not a Y guy, but if you're a Y guy, and you're saying, well, why has the markets dropped down? And what do you think it's going to take to get those higher? I think it's a combination of lack of geopolitical news and more of news here within our borders. And I'm talking about earnings. So I think if we can sunset Iran, if we can sunset Ukraine, if we can sunset those just for the summer, and we have earnings that come in at or better than expectations, I believe we will see new all-time highs. And again, seasonally, that makes a lot of sense too. Because when I look at July and I look at the money counter for July, for the first 2 to 3 weeks, it looks very, very green. All right. We're seeing some fantastic bullish opportunities when you look at seasonality. This week that goes through the 10th, next week, which goes through the 17th, even the third full week of July. Getting out here as we get past the 20th and 21st looks really good. But then look what happens the last week of July. We start to see less bullish opportunities. In fact, take a look at July 30th. Now, I'm not saying that we're changing and everything is going to drop. That's not what I'm saying. I'm saying that patterns that start at the end of July, we have less bullish patterns that start at the end of July than we do right now. So right now, and I'm talking about things that we're seeing now that could take us out to Labor Day, right? We're not seeing as many bullish patterns at the end of the month that take us out to Labor Day as we do today. So that's what we see for the calendar for July. It is bullish, but we're going to start seeing less and less as we get well into summer and get into that month of August. All right, so this week, what's this week look like? Well, this is the week for the ETFs for July 6th to July 10th. We have 91% of the ETFs we're looking at right now are bullish, and it doesn't change that much. It goes to, by the time we get to Friday, it's still 87. So 20 of the 23 ETFs that are on my screen that are giving me signals. Remember, where does this all come from? This comes from decades of data. And what we do is we look at the data and we're trying to see if there's a pattern there. It could be a bullish pattern. It could be a bearish pattern. What do we need to get on this screen? I need at least 9 of the last 10 years where we've seen the same thing happen. In the case of the bulls, 9 of the last 10 years, I need to see these markets moving higher, okay, in 9 of the last 10 years. If it is a bear, and today I got 2 bearish opportunities on here, and I'm going to show you one of them. And then you're going to say, why'd you show me that, Tom? Hang on, and I'll tell you why, what we're talking about in a moment. But if you take a look, you'll see 2 of these are bearish. That means that in at least 9 of the last 10 years, there's 2 symbols that came up on my screen that have notoriously gone down starting today. I'm going to focus on the bulls, and I hope that you do too. So, from there, we could see that this particular week for ETFs and for stocks is extremely bullish. Now, the ETFs that I'm talking about that I want to watch, let's blow this up, take a look at this for a moment. So we're talking about XLY, all right, XLF, and FAZ. Let's do the overview on each, and then we'll talk about a little bit of details on each of these. So if you take a look at all of these, 2 are bulls, 1 is a bear. FAZ is our bearish candidate coming into today. And so when I look at this information, what does this information tells me? It tells me that in the last 10 years, all 3 of these, and of course, I have to say this, there is no guarantee that these are going to do the same thing they've done for the last 10 years. But over the last 10 years, XLY has gone up in 10 of the last 10 years, an average of 6%, right? Between now and the middle of September. XLF, all right? XLF has done the same thing. In 10 of the last 10 years, it's gone up between now and the middle of September. And FAZ, for 10 of the last 10 years, has gone down, all right? An average of 13.5% between now and September 18th. All right. All of these look good. When I look at the data, all of these look good. All right. There's not a losing year in the last 10 years. You see that column that says last loser? There's nothing there because we didn't have a loser in the last 10 years. Do you see the column that says power? These are all positive numbers. This is great. Everything I see on the screen, I like on all 3 of these. So why is this bear a bear? I'm going to tell you about that right now. So we get into the details. Here's what the details look like. So first of all, XLY, for those of you that don't know, is the consumer discretionary sector. All right. This is the things we want, not necessarily the things we need. And this is the consumer discretionary stocks in the S&P 500. Right. So when I talk about houses, I talk about boats, and I talk about, and that's a lot of that's not in the S&P 500, but it's a broad extension of that. But when you take a look at those, you got to think, well, if we're seasonally in an area where these things have gone up year after year, does that mean it's a good time to buy a house? Does that mean it's a good time to buy a boat? It may be. It has been a good time to buy these big things for the last 10 years around this time. And so, no guarantees it's going to be something that goes up this time around. But, you know me, I'm a pattern trader. I like things to repeat themselves over and over again. And so that's an important one. The XLF is is the financial sector. This is the banks. This is the insurance companies, right? These are the guys that are actually reporting next week. And it's a lot to do with why XLF has gone up in 10 of the last 10 years. Now, take a look at that last one. There it is. All right. So that's the Direxion Daily Financial Bear 3X. Okay. 2 big things here. First of all, this is a bearish inverse ETF. So it has gone down when the Russell 1000 has gone up. Now, if the S&P is slated to go up and the QQQ is slated to go up and the Russell is slated to go up, then this should go down. So it is basically a confirmation that we're seeing the bullishness of the markets, within an inverse. The other part of the inverse is a 3X. That means that for every 1% move that we see the Russell go up, FAZ is going to go down by a factor of 3, and vice versa. If the Russell drops back, all right, if the Russell drops back 1%, then FAZ should go higher, right? But all three of these, okay, if we were to back up just a moment, all three of these are telling us that the market is overall bullish. Consumer discretionary looks bullish into the rest of the summer. Financials look good into the summer. And when something goes down, when the markets go up like FAZ, again, that is a confirmation. All right. And guys, I am going to gear up for what I want to talk to you about next. I want to get into seasonality for the S&P 500. I want to talk about what happens between July 4th and Labor Day and how we can take that $7,500 index, and instead of buying it, how about we buy it for $500 or less? That's what I want to do with you guys here next. Hey, I have some thousands for you. I want to talk about thousands of indicators, thousands of opinions, thousands of signals. In fact, very few of those signals are worth the risk. Some of the market's most popular trend trading indicators are only right 30% of the time. And that's because they're designed to capture massive winners. But you got to accept a steady stream of small losses along the way. That's what trend trading is all about. But you know what? Not good enough for me. Shouldn't be good enough for you either. Because when we're looking for what I like to call fast-moving opportunities that are capable of delivering financial gains in a matter of days or weeks, you need more than just another indicator. You need to have a way to filter out what I call the noise, right? You need a way to separate ordinary signals from what I call exceptional opportunities. And that's why Joe Contes and I have come back together with Quantum Trader. Now, if it sounds familiar, you might remember Quantum Trader, and you might remember what we did in the last time we did this before. It wasn't decades we did this. It wasn't years. It was a stretch of 10 months, right, that we put together Quantum Trader. 58 trades delivered gains of 100% or more. We had 9 trades that had 200% or more, and 2 trades for 300% or more. Now, using our proprietary Quantum Scripts process, what we used to do was we filtered out thousands of ordinary market signals. We focused on a small group of stocks that showed the same characteristics over and over again. And those characteristics had explosive moves. Now, we're doing it again, but this time it's much more than an alert service. All right, so join me as a Quantum Trader member, and you'll receive weekly trade alerts straight from Joe and I using our instant trade alert system. So every week we're going to send out 2 trade alerts with entries, adjustments, and exits. We're also going to give you access to our scans as well, right? That's a big bonus here from what we've ever done before. That means you're going to get dozens of signals every week that you can find yourself. Plus, all of this is wrapped up with a 4-week live stream that Joe and myself are scheduling around the end of summer. That way, you can learn exactly the rules and how we find these trades in a live environment. Now, this entire package comes with a members-only website, weekly videos, the Quantum Quick Start course, and it's backed by a money-back guarantee. And until July 17th, the yearly membership fee for this is now 50% off. All right, scan the QR code above or click the link in the description for all the details and become a founding Quantum member today. All right, so I'm looking at the S&P 500 and, coming out of July 4th, to Labor Day, I did a lot of work over the weekend that those of you that follow me on my YouTube channel, you probably saw this particular slide. I put the slide up, I believe it was on July 4th, maybe the day before. And I was actually showing what this looked like. I said, hey, come join me and we'll talk about it. And so I want to get into this in a little bit more with you. So we're going to talk about this this pattern here, right? This 9 out of the last 10-year pattern and what I'm doing with it. All right, between now and July, and I'm actually going to take this $7,500 instrument, the S&P 500, and instead of spending that amount of money, it'd be actually going to be quite more. We're going to take that $7,500 instrument. We're going to come up with a $500 trade based on that. It takes us out to this particular time frame. So let's first get into what this particular slide, where I got this from. So I actually have this software, and I'm showing it to you right now. And so what this software tells me, this is the money calendar. This is seasonal opportunities, and what I've done is I've gone in and I've actually brought up just the S&P 500 itself. So it's showing me that, holding this particular trade or finding a seasonal trade like this and holding it for 43 days. What is it sharing with me here? What shows me in 9 of the last 10 years, buying SPY and holding it for 43 days has resulted in the following. We see 9 of the last 10 years, it has moved up between now and 43 days ahead. If you look at 2016, you can see here, the stock rose from around the lows of 208 to above 218 before closing just below it. I see that for 2017 or 2016. If I look at 2017, same thing. We started out a little bit against the pattern, but then we ran back up toward the end of the pattern. That was 2017. The worst that it ever did was we were down 1% in 2019. You can see where the pattern started and then where the pattern ended. It ended 1% below where it started. The best year was 2020. It was a good year for a lot of stocks and indices. During the summer of 2020, as we had that V-shaped correction going on. And you can see here, we started out around, looks like about 309 on SPY, and we ended at 349. Huge move, nearly 13%. But you can see what this is showing me is it's showing me every single year, and it's showing me exactly what happened every single year with this particular chart. Now, fast forward to today. So if I'm going to take this information that I see here, I need a couple of things. Number one, I need the average time that it took to get there. I need that time. And so it's showing between now and the 2nd of September. All right. The second thing I noticed is it's about 4.5%. So those are the two numbers that I have to write down or I've got to remember as I'm looking at a chart of today. Here's a chart of the S&P 500 today. And so you can see here that since January, we did have a pullback, all right? We have pulled back. And then also you can see the big run up that happened from April to June, the pullback that happened. We had a 38 from floor to ceiling, all right? From the floor of the end of March to the ceiling at the beginning of June, and then the pullback, we pulled back 38% of this bullish move that happened in April, May, and the beginning of June. That's a healthy pullback, right? We look for that 38 to 62% pullback. That's a Fibonacci pullback, and it pulled right back on that number. Now, I want to take a look at where we are today, which is roughly 750. If you take the 750 number, so we know that 10% of 750 is 75. We know that 5% is 37.5. I mean, if we went to 4%, we're probably looking at something around the 30 to, roughly, we look at let's call it 40 points. All right. So if we take 40 points and we add that to 750, now why did I'm taking 4.5% of the number. That's the average number we're looking for. So if we're looking at this seasonally and we're saying, all right, based on the patterns I've seen in the past, I'm projecting that between now and September, right, first week of September, S&P is going to get up there to, around a 40-point move from where we are now. So that puts us at 790. Okay. Now, if we were to add in, that's based on the winners and the loser. If we were to add in a little that power for power meter, it probably puts us up near 800. 800 is also an interesting number because when you add in, other things like trend and more importantly, contrarian strategies, 800 is a 61.8% extension. Okay, 61.8% extension tells us that we're putting ourselves right around 800 for the S&P 500. And that, that puts us somewhere in around the middle of September. Okay, so we've spotted an opportunity. Now let's create the trade. Number 2 is create the trade. I could buy 100 shares of SPY at $750 each. We know what that's going to cost, $75,000. Okay. So how do I take a not a $7,500? That's for 10 shares of stock. But if I put this at 100, and there's a reason why I'm doing this. If I take this $75,000 instrument and I want to put a trade on that costs roughly $500, how do I do that? Well, I know that by trading options, I can get my date down a lot better. Okay, I can get that down quite substantially less. So that's something. The other thing I could do is I could look at those options and I could look at potential spreads to even bring that number down substantially more. So here's what I need to do. First thing I like to do is I like to look at the implied volatility on the S&P 500. And as you can see here, it used to be high and it's come down. And I believe that number is going to get lower. Right now, it's our implied volatility is around an 18 on the S&P 500. I believe and the lows around 17. I believe this is going to get down into the 15 area. And I believe that's going to happen here over the next 2 months. So as we get into September, that number could be substantially lower. And that's good because if the volatility drops, then, because this is not parallel, the S&P 500 should be at new all-time highs. So let's take that information and let's look at some options. I'm not going to look at options that expire next week. I'm not going to look at options that expire next month. I want to look at the options that expire in September. Those are options that have 74 days to expiration. And I'm going to go all the way out here. And if you take a look at the at-the-monies, and the at-the-monies are going to be the 750s. I'm going to put those on the screen here for you right now. So take a look at what these 750 calls are going to cost. They are 22.5 by 22 or 2255 by 2274. So, okay. So we took a $75,000 instrument and by buying one call option, we have the right to buy 100 shares of SPY, but still going to cost, or not SPY. Yes, SPY. Still going to cost us over $2,200 for that call. So how do I get that down to something that's more substantial? Well, first thing I want to look at is my projection. My projection was 790. All right, so that's a conservative projection. So let's go look at see what the 790 calls are going to cost. So I come up here to 790, and that's a target. So if you see here, the 790s are 505 by 508. The problem with buying now, that's a $505 by $508. This is right down there around the $500 range, which is what we're talking about. The problem with buying the 790s for 500 is what if we go to 790 and we get there and we don't go above it, but we get there by the expiration day? Then these could actually expire worthless. We could have been right on our projection, but because we bought out of the money options that were at our target, market could get at our target, and we don't see anything in real value there. So what we want to do is we want to use 790 as a target, and maybe we go down and buy something a little bit cheaper. So how about looking at the 780s? Well, the 780s are 786 by 790. Okay, that's great. Let's look and see what the here's 775s, 965 by 970. All right, let's take a look at the 775s for a moment. And so if I were to go in and actually look at a call option with the 775 strike, and I buy that, right? Now what I've done is I put together a long call option. And here's my 775 call with a September 18th expiration on it. Fantastic. That's well past the September 2nd number that we're looking at. So we're going to have a little time value left. But the problem I see is that, well, this is not $500, Tom. I can't buy half of an option. $500. How do I get this to $500? Well, by getting it, we can get it to $500. We can actually not only do that, but we can also reduce the break even. Because the break even, let's say this is $1,000, then I've got to get to $785 by break even. All right. So how do I get this down? And what we can do is we can use the original 790 strike. All right. So here's my original 790 strike. Remember that 505 by 508? What if we sold that? What if we sold that strike and we create now a call spread? Take a look at this. So here, now we're still long the 775 calls. All right. But we're also short the 790 call. So you're buying the open 775 call and you're selling the open 790 call. And right now, right up the middle, if you split the bids and offers, right, it's showing a net debit of $462. All right. So what's my cost? If I can get it for this, $462. What's my risk? The amount I pay for the spread and no more, which is also $462. The next thing is, what is my return? What's my objective? What's my reward? My maximum reward. Well, maximum reward is going to be the difference between strikes. That's 15 minus what you pay for it. So if we paid $5 for this, $500, and I can collect $1,500, all right, and my risk is 5. My reward's going to be the distance between strikes minus what I paid. So I actually have a potential, if I round this up, $500 risk, but $1,000 reward. That is a 2-to-1. Okay, what's that look like on a risk graph? So if I were to look at a risk curve of this, so here's the S&P 500 chart itself, right, as you see right here. But then if I put the option curve right next to it, this is what it looks like. Okay, there's my maximum risk. Here's break even. Here's my maximum risk. There's that $462 maximum risk. And then here's all the upside reward. Now it gets capped above 790, because above 790, if you're at expiration, no matter how much higher you go up, for every 1 point you're going to make on the 775 call, you're going to lose a point on the 790 call. All right. That's the trade-off when we're looking at lower cost, lower risk, and lower break even. Okay. Because by selling that 790 call, you're bringing in 5 points. That 5 points also drops your break even. So my cost is $462. What's my break even? It's $4.62 above the buy strike. So if your buy strike is 775, then you're going to be at 779.62. Right, it's your break even. So your break even is not that far. It's less than 5 points above the strike you bought. So what you're doing is you're taking advantage of leverage, because now you don't have to pay $75,000 for something, all right, based on something that, if you believe that this could be moving higher. So you're not only doing that, but by spreading this, you're spreading your cost, you're spreading your risk, and you're also lowering that break even and getting that break even down to something that is meaningful. So I thought I would end it right there, folks, with taking ourselves from spotting an opportunity. And the opportunity I'm looking at right now is that summertime bull run, to assessing some alternative trades other than simply going out there and buying SPY, right, for the balance of summer going into Labor Day. And all you do from here is, when you find something that works for you, when you double check this and you find that you like something out there as an alternative, what do? Well, you then plan the trade, and you execute the trade, and you manage the trade. All right. So that's it for me. Hope you enjoyed the program. Keep an eye out on your inbox. I have some videos I'm going to be dropping here later in the week. And of course, if you want to take a look at what we got going on with quantum, all right, we've got that quantum piece I am going to end with that because that is a special that is not going to last forever. Thank you all, and I will see you next week. Hey, I have some thousands for you. I want to talk about thousands of indicators, thousands of opinions, thousands of signals. In fact, very few of those signals are worth the risk. Some of the market's most popular trend trading indicators are only right 30% of the time. And that's because they're designed to capture massive winners. But you got to accept a steady stream of small losses along the way. That's what trend trading is all about. But you know what? Not good enough for me. Shouldn't be good enough for you either. Because when we're looking for what I like to call fast-moving opportunities that are capable of delivering not just regular gains, but substantial gains in a matter of days or weeks, you need more than just another indicator. You need to have a way to filter out what I call the noise, right? You need a way to separate ordinary signals from what I call exceptional opportunities. And that's why Joe Contes and I have come back together with Quantum Trader. Now, if it sounds familiar, you might remember Quantum Trader, and you might remember what we did in the last time we did this before. It wasn't decades we did this. It wasn't years. It was a stretch of 10 months, right, that we put together Quantum Trader. 58 trades delivered gains of 100% or more. We had 9 trades that had 200% or more, and 2 trades for 300% or more. Now, using our proprietary quantum scripts process, what we used to do was we filtered out thousands of ordinary market signals. We focused on a small group of stocks that showed the same characteristics over and over again. And those characteristics had explosive moves. Now, we're doing it again. But this time, it's much more than an alert service, right? So join me as a Quantum Trader member, and you'll receive weekly trade alerts straight from Joe and I using our instant trade alert system. So every week, we're going to send out 2 trade alerts with entries, adjustments, and exits. We're also going to give you access to our scans as well, right? That's a big bonus here from what we've ever done before. That means you're going to get dozens of signals every week that you can find yourself. Plus, all of this is wrapped up with a 4-week live stream that Joe and myself are scheduling around the end of summer. That way, you can learn exactly the rules and how we find these trades in a live environment. Now, this entire package comes with a members-only website, weekly videos, the Quantum Quick Start course, and it's backed by a money-back guarantee. And until July 17th, the yearly membership fee for this is now 50% off. All right, scan the QR code above or click the link in the description for all the details and become a founding Quantum member today.